the Basel III regulations said that the banks had to maintain a 4.5% reserve ratio. It's been zero for quite some time. So when you think about it, you aren't depositing money in this bank. You're giving them an unsecured loan that they're buying assets with. It's gone. They only have to keep 4.5 cents on the dollar in the bank, and so they're making loans. and after the crisis that we saw with the treasuries, and now we see an environment where, okay, maybe they're buying 10-year treasuries again, thinking, okay, we everything's okay. Rates are higher and it's maybe safe to buy it. And then what do they try to do? They try to lower the front end of the curve and the back end goes up, putting the bank's balance sheet in worse position again. These are problems that will not go away. These are problems that are, I think, systemic to the system. They won't go away. And part of me feels as though that's the intention here. I mean, you ask yourself, why would the Federal Reserve, in essence, goad all of the banks into loading up on treasuries and fueling the narrative of low interest rates forever, only to then raise them by 500 basis points, the fastest raise ever in the period of a year, creating these problems? It's absolutely insanity. But I do think that, the FDIC or the troubled bank list, so there's over 60 plus banks. There's probably a whole lot more than that are in real trouble. And I don't think the First National Bank of Lindsay was on that list. So anyways, yeah, I would just simply say the banks are not in good shape. If you have money in any bank account above the FDIC limit, I think it's insanity. And we were told this by Powell. There would be consolidations. This is what they want. They don't want 5,000 banks. They want a much smaller network of banks as we transition into central bank digital currencies, making it much easier to roll out modern monetary theory if we really go down that path. But this is just beginning, done again. If the Fed doesn't come in like they have before, everyone says, well, if you just would have left your money in the stock market after 08, and you would have been made whole. Yeah, well, the Fed added $9 trillion into the kitty to support, the bond market, to depress interest rates, to support the stock market, the real estate market. It's all artificial. It was all propped up by a Fed who came to the rescue. What would the world look like had they not done that? And I think that's what you need to ask yourself. And the question is, will they come to the rescue again this time? And if they do, what does the rest of the world think about holding our treasuries of any duration and our currency that is being inflated away? That's the question that has to be asked. So, you get to a point where you're so far in debt, you need, let me phrase it this way. We had the second biggest trade deficit in history last month, like 108 billion or something. Well, if that doesn't tell you how important it is for this country to be the world reserve currency, and how reliant we are on the rest of the world for imports, because we are reliant upon these people taking our dollar for their goods, and we are very reliant upon buying their goods because we've offshored so much of our production and manufacturing, and it's not sustainable. You end up compromising the world's desire to hold your currency and to hold your treasuries. That's when things start to really snowball. Now, we're not there yet, obviously, but these are the kind of actions that lead to an acceleration, lead to that moment where the world says, yeah, I don't want any more dollars, or I don't want your treasuries. And this is the rise of the BRICS and trading in local currencies, and why gold is doing what it's doing. So it's all one big dirty mess, but it's all connected together.
Schectman begins by analyzing the implications of the Basel III regulations, which set a minimum reserve requirement of 4.5% for banks. For context, this means that banks are only required to keep 4.5 cents for every dollar deposited. This minimal reserve ratio highlights the reality that when we deposit money in a bank, we're essentially providing an unsecured loan to the institution, which then uses those funds to buy assets or make additional loans. Our money isn't really in the bank, it's invested elsewhere, often in assets subject to market risks. The banking sector's reliance on treasuries further complicates this picture. After the 2008 crisis, banks were encouraged to invest in treasuries under the assumption that low interest rates would be sustained long-term. However, the Federal Reserve's sharp increase in interest rates by 500 basis points over a single year created a shockwave, reducing the market value of the treasuries banks had been incentivized to buy. This left banks holding long-term debt assets at a loss, a situation worsened by the Fed's attempts to manage inflation and interest rates. Schectman sees this predicament as systemic, a reflection of deeper issues within the fiat system. When interest rates rise, banks are forced to reconcile their balance sheets, often revealing vulnerabilities that were previously masked by low-rate policies. The rapid rate hikes have already put a strain on many banks, leading to concerns about stability and even prompting some institutions to appear on troubled bank lists. The recent failure of the First National Bank of Lindsay exemplifies this trend, and Schectman suggests that more banks may be in precarious positions that could lead to consolidation in the sector. The Federal Reserve's decision to raise rates so dramatically, effectively pulling the rug out from under the banks it encouraged to load up on treasuries, leaves one questioning the broader goals of such policies. Schectman hints that the push toward consolidation in the banking sector may align with a longer-term vision, the eventual rollout of central bank digital currencies, or CBDCs. Reducing the number of banks would make it easier for central authorities to implement CBDCs and monitor monetary flows directly, particularly if they intend to enact policies aligned with modern monetary theory. This potential shift also brings the stability of fiat currency into question. For years, the Federal Reserve's intervention in the stock and bond markets has propped up asset prices, allowing the illusion of prosperity to continue. But as Schectman notes, the reality is that these interventions are artificial, fueled by injections of liquidity rather than organic economic growth. Should the Fed choose not to intervene in a future crisis, we may witness a rapid correction in asset prices. And if they do intervene again, it raises questions about the long-term value of the dollar as more currency enters circulation. This brings us to the issue of the U.S. trade deficit, which reached its second highest level recently at around $108 billion. This dependence on foreign goods and services highlights the U.S. economy's reliance on maintaining the dollar's reserve currency status. Without global demand for dollars, sustaining such a high level of imports would become impossible, potentially triggering inflation and weakening the currency. However, as BRICS nations and others begin to trade in local currencies or shift their reserves to assets like gold, the dollar's position could gradually erode, creating a perfect storm for inflation and currency devaluation. Given these dynamics, Schectman argues that the U.S. Treasury market is becoming increasingly unattractive. Long-duration treasuries, in particular, are vulnerable to inflation, which erodes the real returns investors can expect. For individuals and institutions holding treasuries, the likelihood of losing purchasing power in an inflationary environment makes these assets risky. As the Fed continues to manipulate interest rates, investors are realizing that holding U.S. debt may no longer offer the stability it once did, particularly when better options like gold are available. This context explains why gold prices have continued to rise despite the Fed's attempts to manage inflation. Gold, which lacks counterparty risk and offers a stable store of value, is becoming increasingly attractive as a hedge against fiat instability. Central banks around the world have been quietly accumulating gold, a trend that reflects their understanding of its importance as a reserve asset. According to Schectman, the most well-informed traders globally are these central banks, and their actions signal an understanding that fiat currencies face an uncertain future.
Well, I mean, I think there's a global need for a reliable store of value done again, and this is to facilitate trade and to safeguard excess capital. And I think the key is also without counterparty risk. I don't think the bonds can longer fully provide either. You see the Fed lower rates, as we've talked about. There's all this talk of signaling victory over inflation, but it's not. They were 60+% away from their target at 2%. What it is raising the white flag. What it is massaging and manipulating the numbers that comprise the CPI out of the Bureau of Labor Statistics. And whether it be about unemployment or about inflation, the numbers that come out of there are suspect, to say the least. And what we are seeing, really, as far as I'm concerned, is the market's way of saying, at this point, buying any duration treasury. This is me talking. Let me just say this, that anyone who would buy any duration treasury, 10-year, or longer, to me is crazy. I think they're uninvestable. The Fed will lie about inflation. Inflation will only get higher from here, especially by lowering the front end. And the market understands this. Gold understands this. This is why gold is roaring. This is why the bond market is selling off and rates are going higher. And of course, you can talk about the weaponization of the treasury market, which only adds fuel to that fire. But this is something that I would expect to see continue. You cannot expect to lower rates, go back to an inflationary policy, especially with asset prices at all-time highs, and not expect there to be consequences on the back end of the curve, where holding at these rates for any duration when inflation will erode and eat away at the purchasing power is insanity. And so I think that's the market saying just that. The concept of holding debt as an asset, I don't think is something that has a massive historical footprint. When you over-lever the debt the way that we have, and this debt that's very interest rate sensitive, and then rates start to go higher and the economy starts to slow, the maintaining of debt becomes very big deal. And if the debt isn't able to be serviced, and this is the whole concept of credit default swaps, where if you're trading with another partner who you don't quite trust, you take out an insurance policy against them and their ability to pay. And the insurance company's like, well, that's big money. Let's do it. And then boom, it blows up. And then real quick, the whole thing starts to spin out of control. So it's a problem. It's a problem that has to be dealt with. And this debt problem, it can't really be paid back. So the ironic thing about it is that most of it is owed to the American people, Medicare, Medicaid, Social Security, the government and military pensions. And so much of the money that's gone into treasuries has, as the foreigners have been selling them, we've been buying them chasing yield. So if you really want to get into the weeds and talk about resetting the system, we're resetting predominantly upon the American people. Only about 7 trillion is owed. That's a lot to the rest of the world, but to the American people, it's the majority. And what I was looking for earlier, by the way, Bank of America survey showed that 71% of financial advisors had a 0 to 1% allocation to gold. This was at the end of 2023, while only 27% had a 1 to 5% exposure. Shockingly, just 2% of advisors reported a 5 to 10% allocation. And, we're nowhere near the top in this bull market, as the American participation in the face of, positive real yields, if you believe the BLS and the BLS and the CPI, positive real yield, strong dollar, no American participation, nothing in terms of institutional money, and it still goes higher. And that's because of the central banks. They're the most well-informed traders in the world, and Wall Street will catch on.
As we continue exploring Andy Schectman's perspective, it's clear that the challenges within the U.S. financial system aren't isolated issues. They reflect fundamental shifts in how nations and central banks view currency, debt, and value. For Schectman, these trends underscore why gold and silver may be the most reliable assets for protecting wealth as the global economic landscape undergoes profound changes. Schectman emphasizes that central banks have become some of the largest buyers of gold in recent years, a trend driven by both necessity and strategy. With fiat currency losing purchasing power due to inflationary pressures, central banks worldwide are diversifying their reserves away from dollar-denominated assets and into tangible stores of value. Gold's status as a universally recognized asset with no counterparty risk makes it uniquely suited for this role, especially in a world where financial stability is no longer taken for granted. This movement toward gold accumulation is particularly notable among central banks in emerging markets and BRICS nations. For these countries, holding gold reduces reliance on the US dollar and provides a hedge against currency devaluation. By increasing their gold reserves, these nations are effectively building a financial firewall against the instability they see in dollar-dominated assets. For individual investors, the actions of central banks are an indicator of where value and security may lie in the coming years. If these large influential entities are shifting their reserves to gold, it suggests they anticipate a future where fiat currency could be significantly weakened. In addition to central banks, institutional investors are beginning to recognize the limitations of traditional assets, particularly long-duration treasuries. Rising interest rates have made it increasingly difficult to hold U.S. debt without facing losses. Schectman describes investing in long-duration treasuries as insane in today's climate, where inflation erodes purchasing power at a pace faster than the returns offered by these bonds. As the Fed manipulates short-term rates while the long-term rates climb, treasuries' appeal as safe haven assets diminishes, especially when compared to gold, which has shown resilience and appreciation even during periods of financial turbulence. Schectman notes that American investors, on average, have very low allocations to gold and silver, with most portfolios holding less than 1% in precious metals. This contrasts sharply with the actions of central banks, which have been steadily accumulating gold over the past decade. According to Schectman, this lack of American participation in the gold market presents a unique opportunity for early adopters. Should mainstream U.S. investors begin to recognize the value of gold in a devaluing fiat system, demand could skyrocket, driving prices even higher. The fact that gold's price has risen without significant U.S. participation reflects the strength of global demand and signals a potential for further growth as more investors turn to metals for stability. The Treasury market's volatility, combined with the growing skepticism around fiat currency, is pushing investors to reevaluate their portfolios. Schectman argues that the current economic climate is unlike any we've seen before, marked by record levels of debt, manipulation of inflation data, and geopolitical shifts. In such an environment, the traditional reliance on debt as an asset may no longer be sustainable. High levels of public and private debt, especially when interest rates rise, increase the likelihood of defaults and credit crises. Precious metals offer a safeguard against these risks, maintaining value in a way that fiat currency and debt instruments cannot. The concept of modern monetary theory, MMT, also looms large in Schectman's analysis. MMT posits that governments can issue currency to finance their expenditures without needing to worry about debt repayment, as long as they control inflation through interest rates. However, this approach has led to higher debt levels and inflation in practice, further reducing trust in fiat systems. Schectman cautions that as MMT principles gain traction, they could accelerate the devaluation of fiat currency. For individual investors, this trend highlights the importance of tangible assets like gold and silver, which retain value independent of monetary policies and economic cycles. Schectman also points out that the Federal Reserve's actions are a form of raising the white flag, rather than a true victory over inflation. Although the Fed may claim to control inflation, real-world data, such as rising costs of goods and services, suggests otherwise. By manipulating short-term interest rates while inflation remains high, the Fed is sending mixed signals to the market, undermining confidence in the dollar. This erosion of trust has prompted central banks, institutions, and some individual investors to seek alternatives like gold, which is not subject to the same policy-driven volatility. For investors considering precious metals, Schectman's insights are a reminder of the unique attributes that make gold and silver valuable during times of financial instability. Unlike fiat currency, which can be printed indefinitely, or debt, which carries counterparty risk, precious metals offer a form of wealth preservation that is independent of government policies and economic cycles. In a world where currency values fluctuate and debt burdens grow, holding assets with intrinsic value provides a safeguard that few other investments can match. Looking ahead, Schectman suggests that we may be on the brink of a fundamental revaluation of assets. As global trust in fiat currency wanes, the demand for tangible assets is likely to increase, leading to potential price surges in gold and silver. For those who invest early, this could mean significant appreciation in value. And unlike other assets that are susceptible to economic downturns, precious metals tend to retain value or even appreciate during crises, offering a form of insurance against the risks associated with fiat currency and debt. In conclusion, Schectman's analysis provides a compelling case for the strategic role of precious metals in today's economic landscape. As the financial system faces unprecedented challenges, from rising debt levels to declining confidence in fiat currency, gold and silver stand out as pillars of stability. For investors, this shift represents both a challenge and an opportunity. Those who recognize the value of tangible assets and act accordingly may be better positioned to preserve wealth in a world of increasing financial uncertainty. Thank you for joining us in this expanded discussion. In an age where monetary policies and economic conditions are increasingly volatile, the role of gold and silver as true stores of value becomes ever more apparent. Those who understand and act on these insights are likely to be well prepared for whatever the future holds.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.